Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, October 26, 2021. What we're going to do in this video is start out with an update on the broad markets. Definitely want to talk on the market-leading FAANG stocks. There's a few things to go over there, including but not limited to the fact that we already have Facebook out of the way, one of the 5 market-leading FAANG stocks. 2 more to report tonight after the close, Microsoft and Alphabet, followed by Apple and Amazon on Thursday. And so I'm going to give you levels to watch, my thoughts on where things might be going, follow up with an update on natural gas, definitely the metals I want to hit. I got a post out to you today. Not much more to add than that, but that one's just playing out almost perfectly to the T on all the levels that we've highlighted, all the targets that were laid out in recent weeks. And then time permitting, quick update on lean hogs and live cattle. Those are 2 trade ideas I threw out recently, and I'll try to do an update there for you. Okay dokie, let's start here with NQ, NASDAQ 100, 2-hour candles. Here's our primary trend line right there, which was broken. We had a smaller trend line here, and that was on the 60-minute charts. That's the sell signal that we got way back here, and we're coming up on that now. Let me just make sure this is here. We got to move that line right here. I had a divergence line, and I still do. I'm going to take that divergence line. Hopefully you can make that out in the video. Maybe I'll zoom in a second here if I can grab it. There we go. So we're right about at that the previous peak right there. Like I said, that would give us, should we reverse on or around this area, you know, give or take within a few percentage points. And I'm going to tell you, I'm going to say it right now, I still think we do. If we do that, then that's going to give us a double top high. Let's just look at the technicals. You know, we all have our opinions. I know those of you that might have been holding out for that third target or layered back into some shorts after we hit T2 and bounced, or anywhere in between, you know, might be a little frustrated with the extent of this bounce. But at the end of the day, if you want to strip everything away, forget about what's happened, look at the current technical posture of the market. Look at these divergences. They continue to build. We started building divergence most recently on the 60-minute chart from this peak, at least in the RSI, right about here. So this last thrust up, before that, we did have divergence on the PPO down here. Again, this is a 2-hour candles. We can go to the 60-minute chart. We'll see something similar. So there's our divergence now. And so let's just look at the facts here. Last time we had comparable divergence, it was pointed out, and we all know what happened. That was here. That was the biggest correction in many, many months. 10% or so drop in the NASDAQ 100 right there off that divergent high. And that one also took out the primary trend line right there, which made it different from these. These were little divergences, and they all played out for corrections. Big divergent low back here, and you know, likewise I always point these out. So whether you agree with where I think the market's going, I'll point out these developments, and then you can decide. And as I said, at dip buyers, I said, look, if you're bullish, all this divergent low, these 60-minute divergent lows are the best place to go long on corrections. They have been historically, and it looks like this time it'll be, if we can pop that by a good amount. The catalyst to the move to new highs. That's been the MO for years now, really. Market puts in these corrections, puts in a divergent low on the 60-minute time frame, and then moves on to new highs. Now, the million-dollar question is it going to break out and run, or are we going to have a marginal new high followed by a correction? And again, I've said it many times, that has been the MO on much, much more often than not. Every time the market, after a correction with, you know, spacing of at least a few weeks, anytime it's made a marginal new high, that's all it's been. You know, unlike, you know, when you trade stocks, often if stocks have a all-time high and they're bouncing on, they break out, and that's usually break out and they run. They either back test and take off, or they just run from there. But in the case of the Qs and the S&P 500, every time it makes that marginal new high, it seems to correct. So all right, let's get off that. Let's just leave it for what it is, and that is we have negative divergences. No sell signals right now, but I'm going to talk about the FAANGs real quick and what to look for. So that is NQ. That's what it looks like on the 60-minute chart for you active traders. There's the I'm sorry, that was a 120-minute chart. This is a 60-minute chart. You can see we're right about up to those previous highs, give or take, right there, close enough. And there's our divergence line. All I have to do is pick it up right here. Divergence continues to build, and it's still intact. If we go up and we take out the previous highs right here on these indicators, then we no longer have negative divergence. I don't know where all the lines went. Oh, yeah, I know what happened. I rolled the futures. These are this, this is the same chart I had before. We had divergence here. This was a divergent high up here. We had a divergent high over there. Again, all the lines are cleared out, but that was our most recent divergent low, which was the catalyst for this move up here. So, everything goes in waves, and those waves, the tradable trends, not investors. Investors sit tight and wait for the long-term indicators to roll over, but swing traders, that's the trends you want to trade, and these are 10% moves. And so an investor in the last couple months has gone absolutely nowhere. They were here, and then they went down, and now they're back to where they started. Whereas an active trader or a swing trader, even not a very active one, will micromanage these rips and dips, and that's what we did. I mentioned, posted a short here on the breakdowns, going long here, covering and gaming the bounce for an active trader, getting back short, going down somewhere in here. I forget where it was. We hit T2 and bounce as well. Maybe that was T2 and that was T1. I'm trying to remember where they are because again, these lines are gone now. But on QQQ we did all that. Here, I'll show you that. So the point being that an active trader over that period of, let me tell you exactly what it was, since we peaked back there, 1.6 months, an active trader, could have profited, what was that, from the sell signals in here somewhere down to T1. T1 was actually, we gapped down below T1, so T2, so we gapped down right below T1, so I didn't post to bounce or to reverse there long, but that's where I said we'd get a reaction. You could go long. That was a 5% drop. I had a minimum target right here, bounce target, top of the uppermost range was a backfill that gap, so that was roughly 3%. And so when you add all those together and then go short again, and then what happens? So far, we've reversed shy of my third target, but again, the divergences were pointed out there, and these were the levels to scale back into short. Pretty much any or all of these levels. So let's get to the FAAMGs now, and I'll tell you, this is where I think there's still a good chance we go down. It's going to be choppy, I'll tell you that. We only have 2 more of the FAAMGs reporting today and the last 2 on Thursday, so the rest of the week will be choppy. So whether we do this or this, I think that's it. I think the upside's minimal. And remember, the markets are just one trade. It's like having a diversified portfolio of 10 stocks. And if you're trading the market, QQQ, you're trading 100 stocks with one ETF or one futures contract, but it's only one position. I cannot overestimate the benefit of diversification, and that's why I'm throwing out trade ideas that fewer sites do. I'm trading one day. I'm trading live cattle and copper and individual stocks and government bonds and corporate bonds and you name it, Bitcoin. These are all the things that I like to incorporate whatever I see in the charts, and they have very little to any correlation. So the point is, you're going to be up on one day, or down on one, and hopefully up on 3 or 4 other positions. So let's move on. There it is, divergences. And before we move away from the markets, I'm going to go on the small caps real quick and tell you I'm still reiterating the sell signal that we got there. I am not crazy about the fact that we popped up inside the wedge, but nothing technically. Other than that, we had a couple whipsaws. I will have to say, nothing technical. That was a whipsaw right there. But the posture of RTY, and that's what I jumped over to, the small cap futures, 6-month chart, 2-hour candles, nothing has changed. We've had these divergent highs, correction, divergent highs, and usually the trend line breaks are it. Sometimes you break and you kick back. Here you had a kickback rally. It didn't carry back into the wedge. But what we have right now, just like we had at this point, divergent high, this point, divergent high, correction, correction, divergent high right there, correction, divergent high right there, correction, divergent high, correction, and divergent high, correction. So what will really help is to see the market sell off on any of the earnings tonight. That would certainly help and get, if the large caps sell off, it'll probably bring the small caps down below this wedge. And again, it's a pretty clean trend line. I'm going to zoom in for you real quick and show you that that technical posture hasn't changed. Now, like anything else, stops are a must. I gave you targets, 2248 in this uptrend line. So that is from where we're at now, or let's just say from where we broke down the other day. If you took that sell signal, let's go from right there. Then you're talking, and that's a minimum target, and this is an active trade, just a short-term first target, about a 2 point, from that point, about a 3% downside. So you want to have a stop not much more than where we're at right now, and that kind of meshes with what's going to happen today. Either these fangs, the market's going to rally after hours and into tomorrow, or it's going to sell off on the earnings today, and that'll bring you down there. Now, if you short today, we still have the divergence. And again, that's just a first and minimal target. When you go back out, pull back out here, what's the, where are we likely to go after the divergent eye is the bottom of this range. You can see this is the bottom of the range. It's not a hard bottom. I'll tell you, the bottom runs from about right here to down to there, and that's uppermost. You have a lot of reactions there, and you have some all the way down towards the bottom of this range, and that would be, swing to the bottom of the range would be about a 10% drop. So if you're going for that, then you could allow for a considerably wider stop. It would be off this chart, but you also want to keep an eye on these recent highs. That's the top of the trading range right here, these highs from earlier back in, looks like early June and mid to late June right there. Okay, let's talk earnings. We'll go in this order. Well, Facebook already reported, and so far lackluster. It's still holding support. Remember on that 60-minute chart, you had the downtrend line breakout right here. We're right around that level of the breakout on the 60-minute chart. And even if Facebook makes a new low, it's going to be a divergent low unless it can take that out by moving much lower. So right now, kind of questionable, and I'll just say this: if the market, the big fangs, the rest of them hold up and rally after earnings, I think Facebook will still pan out even if it has another low. Remember, we're still above those key. Actually, we're testing them again. There's that 200-day simple moving average. I told you that's the more important of the two, the blue one. There's 200 exponential, and the buyer stepped in there a couple times, but this is the one that's done a better job over time, the simple moving average, and that's where that last trade was mentioned as an objective long, and it bounced back to it, testing. So okay, let me just tell you where I think this was going. I think we're going to sell off after FAANG earnings, and I think Facebook will take out the 200, and that's going to be a pretty powerful sell signal. You look at the posture right here, bigger picture on the daily time frame is we had put in a big divergent high recently. This right here was a big old divergent high, negative divergence. Then you broke this trend line we've been moving down, and we got a bounce. We bounced pretty nice off the 200, but we're back there again on it. And we were on it there, we were on it there. I've done this before. You go back in time, but when you break it, that's bad. That's where we broke it right there, had that big drop, and so watch that. And look at the posture of the PPO as well. See, it's down here in bearish territory, well below the zero line, and it made a bullish cross right here recently, but now it's pointed down, poised to, it hasn't yet done so, but poised to make a bearish crossover. So that's Facebook. They reported first. They reported yesterday. Today we have Apple. And no, I'm sorry, Microsoft and Alphabet. So let's look at that real quick. Microsoft, what do I see on the daily chart? Nothing's changed for months. We have these divergences building, especially from this point right here. This is where the RSI started, hit overbought and started to diverge from here to here. So this is our current divergence. So that would be DH right here, divergent high. Minor trend line right there. That'll show better on the 60-minute chart. Big support there, about 283.10. And again, if these divergences play out, they would indicate something larger than just a 2-3% pullback. It'd probably be a double-digit pullback. All right, and there's the 60-minute chart. Microsoft broke down. It just didn't get, the traders didn't get the memo yet. It broke down, And since then, when it broke down right here, we had just started to form some divergence on the RSI. Now that divergence is even larger right there. So there it is. You can see the divergence with today's high, trend line break, and a perfect back test. So if the technicals play out, this is a breakdown, back test. And the thing about trading breakouts or breakdowns, you don't take them right before earnings unless you're just a gambler. You want to wait till earnings is over. So this is going to do one of two things. If the technicals play out, it should get rejected off the back test. And if it does, you're going to look for this level right here, 306, big level. Why is that a big level? Well, it was a triple top right there on the 60-minute time frame, and Microsoft recently broke out. So if it fails it, that's going to be a false breakout. And these divergences will play out. Last time we had a divergent high was right here, and that was good for I'm just measuring for you, that was good for a drop of about 9% in Microsoft. Okay, let's move forward here. Alphabet, kind of choppy on the 60-minute chart, but what stands out to me is I'm rolling back in time here. We have a primary trend line here that was broken, and it came after a pretty big divergent high. Breakdown, back test, and again, this is on a sell signal. Call it what you want. I know it's not far off all-time highs, but there's a breakdown, and we're still below the primary trend line, and we have some divergence here on the 60-minute chart. Daily chart, there it is. This is a big trend line right here. It goes all the way off the March of 2020 lows, what I call the COVID lows, and you can see we broke down and back tested, and we're below it. So that is a powerful sell signal that, hey, the rest of the market doesn't see it. I see it. May not play out. Sometimes that happens. You can have one FAANG breakdown. If the rest hold up, then that'll prove to be a whipsaw. But if you're a purist and just looking at the technical posture, you say, well, there's a breakdown, back test. We're still below the trend line. Unless that trend line's regained, that's a sell signal, and that should take Alphabet lower. All right, Apple and Amazon. Let me cover Apple, okay, because those are the two reporting tonight, Microsoft and Alphabet. Apple, let me just show you this. Apple has a history, not a solid history, but a decent history of selling off after earnings. But what I've noticed in the pattern, and this is true with most stocks, that usually happens after the stock's been running up. So what I have here, you can probably see all these vertical lines show you the earnings dates on Apple. And when you get especially earnings coming into after a big run up, a pretty good uptrend in Apple, and you have negative divergence, that is usually marks a top. And in this case, the initial reaction was sold. They rallied it back up, made a marginal new high, but you pretty much went nowhere. In other words, you could have shorted Apple before earnings based on the divergent high in the earnings and caught all that drop. That drop was roughly, just ballpark figure here, about 35%. And but when the stock has been washed out after that was the biggest drop. That was a bear market technically. Then the next earnings, your chances are you're going to go up because you've already flushed out a lot of weak hands. So that was earnings. I'll just mention that one. You would have probably looked to go long, but there was a big run up, and I'll say this: that after the big run up, they reported. And they gapped up to right here, and it rallied, but then it came right back down to where it gapped up to. So you were kind of like a roundabout way. Back in a few weeks, you were where you started. It did it again until the next earnings. But here it had a correction, if you look at this. So I'm just analyzing here is what I'm doing, guys. After that drop, they reported, and because it had already corrected, that was bullish. But then a big rally in earnings right there. That was January 26th they reported. That was the fourth quarter earnings. And it had, there it is, the divergent high. So you had a nice rally into earnings, divergent high. Boom, they sold it hard. Next earnings, you had a rally into earnings. Boom, they sold it. Another one, you had a rally into earnings. They didn't sell it, but it didn't really go anywhere. That last earnings report was July 27th, and we're only marginally a couple percentage points above it, I'm sorry. And then the correction came, and it took that divergent high. Here, right now, we don't have a divergent high, but we are coming off one. We're coming off that divergent high. there was a correction. I'm just going to say I don't have a strong opinion. I just wanted to kind of show you, and you can do this yourself. Examine a stock and see how it trades in earnings. I don't have a very strong opinion on Apple on that daily chart. When I look at the 60-minute chart, I will say this: it's got this. It had a bullish falling wedge here, which was pointed out on the 60-minute chart. Divergent low broke down, and it's got this little megaphone pattern now. Technically, you have divergence right now. You do, because you're making lower lows in the indicators. But it would look a little cleaner, if that makes sense, if got a little pop after earnings and then put in a nice, two clean peaks in the PPO would give it nice divergence, in my opinion. But again, we have a couple days to worry about Apple and Amazon. Amazon, AMZN, has just been a chop fest, really pretty much going nowhere for a long time on the daily chart. And again, the big thing here, put in a divergent high back right here just before they reported last earnings right there on July 29th. So again, here's another instance of a big FAANG rallying up into earnings for the most part. Peaked a little before it, but still rallied into it, and then they sold it off. That was an earnings date, I believe, right there on that arrow, and I think that one as well. You can see I don't have them all marked up here. Either way, kind of sloppy sideways action in Amazon right now. And so I'll focus on these two as we get closer to their earnings on Thursday after the close. And a quick update on natural gas. It did end up getting smacked down on that 622 and potential trendline backtest. That's where it was yesterday. Had a big up day and now a big down day. And again, this is the nature of the beast. It was down, I don't think, 6 or 7% earlier, at least over 5. It's only down about 4 right now, but still, when I say only, that's but you can see these red candles. So either way, rejection at resistance. Remember, this was the tag of both that 497-ish big support level, as well as the more important uptrend line on the daily chart I showed you yesterday. So a bounce was to be expected from there, and we got it. And it's still below. Now, what I'm seeing here, look at this volatility recently. And let me show you something here. Let me go to a daily chart. Look at daily candlesticks. And what you can see, let me take it in a little tighter here. Okay, a couple things. They have a primary trend line. So here's a daily chart of natural gas futures. And what I have here is a potential head and shoulders pattern. That's why I say LS question mark. This is a possible left shoulder. Actually, from right here, let me clear that out. It may be very clear here. Possible left shoulder, possible head, possible right shoulder. That's why I have question marks there on each one, because you need to reverse and keep the symmetry of the pattern intact. You don't want to meet or exceed that head. So this would be your neckline right here. And you can just see, look at the size of these candles. Look how volatility is just getting really high in natural gas recently. As I mentioned, huge big day yesterday, up, big down day. You can see big green candles followed by big red candles. This one was a bearish engulfing candle. That still has, as I pointed out before, the potential to mark a significant top. So where am I going? What am I watching for on natural gas? This again would be the neckline of a head and shoulders pattern. If nat gas reverses from here, you want to see one of two things. You want to see it fairly impulsive, and you want to see it on increasing volume. Head and shoulders patterns are one of the most recognizable patterns in trading, and I think traders kind of throw them out there and use them too often. One of the most important things is to confirm the pattern on volume. And to confirm volume, there's two things you want to see. You want to see increased volume off the on the formation of the head, off the top of the head down to the base of the right shoulder, and then you want to see again increased volume. So that's what I want to see here, is increased selling, increased volume, and of course, most importantly, a move down on a drop down to the neckline. At that point, I take these question marks away, because we no longer have a potential head and shoulders pattern. We have a confirmed pattern. Now we don't have a sell signal, any chart pattern that would just finish or finalize the pattern. Then the sell signal would come on a break down below the neckline. This is your neckline right here. and L, this line right here. And I really like it because you also have your primary trend line just below as well. And that's that trend line, you know, it showed better on the chart of nat gas I showed you on stock charts. We hit it to the button the other day and bounced. And so that would be not just one sell signal, but two levels. It would be a powerful sell signal, two key support levels taken out at the same time. So it's a big if. You know, if tomorrow, next few days it does this, guess what? These lines go away, and we never formed a head and shoulders pattern. We had what could have been one, but didn't materialize. So that's what I'm looking for. And quite often, it's very aggressive, but I mentioned, you know, strategy is shorting right above when you see what may materialize into a head and shoulders. You can take a pot shot short trade right there with a stop somewhat above. And I like it because the risk reward is very good. You know, the odds of the trade playing out might not be the best because you don't have a fully formed pattern, but if you keep a relatively tight stop, your entry point is here, at least maybe on a half position. And if you do get that move down, then what you want to do is add to your position if and when the pattern triggers, and now you have really nice cost basis because you've averaged, you know, took a lot there and maybe the second lot on the breakdown, and then the measured target's going to be the distance from the highest point of the head down to the neckline, and that would give you a nice drop in nat gas if that happens. So 5 minutes talking about a bunch of ifs, but the ifs can happen, you know, incrementally, and as and if it continues to develop like that, it's going to increase the chance that you get that pattern, and then of course a breakdown is going to increase the odds even better of a pretty big move down in nat gas. Oh, and if I forgot to mention this, one more thing is this. You know, I like on my head and shoulders patterns. You know, some people when they go to a restaurant, they like their steaks medium rare. Some like them well done. I like to see my head and shoulders patterns with negative divergence at the head, at the peak. And that's what we have here. So that is, to me, another check mark. Last check mark will come on a high volume move down to the neckline, and then, well, the next check mark, that is, and then the final check mark will come on an impulsive breakdown below the neckline and the primary trend line. All right, I'll wrap the video up here on gold and silver. Okay, I'll touch on the hogs and cattle real quick. There's just not much there. I'm cooled off from that trade, but I'll do an update for you real quick. But this one's just played out perfectly. This is silver, which has been my preferred trade out of the two, but I'm diversified into gold, silver, but you know, leaning heavier weighted in silver. Divergent low, this 120-minute chart. Breakout, back test, and again, all these levels were laid out in advance. We broke out of the trend line, hit that 24.01 level, followed by our $24 level, followed by reaction. Ran up, just hit this 24.867 level. Again, levels laid out well in advance. And you know, I'll tell you, technical analysis, at least my version of it, isn't working so great on the markets with underestimating how far we'd probably bounce on this, even though we're kind of still pushing the upper limits of my bounce. So it's not over. I'm still maintaining T3 on QQQ, but this one's just, the technicals are playing out perfectly. Traders are stepping in exactly at these levels. So an active trader, you know, could have booked profits there, recycle back in, and now we pulled back to, as I said, not one but dual support levels. At 24.01 was a former price target here that was hit. It was resistance. Then when we broke resistance, as is usual, we go up to the next target, and now it's an objective level. If we break that level, it's not going to be ideal, but it's not going to completely put a knife through the heart of the bulls, because we still have a big level down here, about 23. That was a former resistance level, big level right here that was broken out, plus the downtrend line. So it's not my preferred scenario, but it's one that I'll be adding to silver if we get back there. And then anything much below that means that we fail to break out. You know, if we come back, test the trend line and move up, great. If we fall back below there, especially take out 22, that's just not going to be good for silver. I don't think it's going to happen, but that's what stops are for. You know, if wrong, get out, move on to the next one. But as of now, I still think we're going to probably bounce here and run up to that 25.85-ish level, next target there. That's silver. Again, I already gave you a chart there. And the same thing in gold. You know, not a coincidence at all. We hit the 1809 target twice in the last few sessions, had a reaction, give you two opportunities to book profits there. We've been dancing, pulling back to this trend line that was mentioned as an objective long entry on the pullbacks there, and here we are again. So we're at not just trend line support, but price support as well. 1783 right here was a level on this chart for a while. It's support, and that's it. So like I said, it either works or not. If the trend line breaks, yeah, it's going to be near-term bearish. Can probably usher in some sellers. Stops probably will get hit. And there's really good support down here around 1750 or so. So that would be, let's call it, for lack of better words, my worst case bullish scenario. In other words, that could happen and still keep the bullish scenario intact. But anything, of course, if we take out that 1721, that's just going to be ugly. And if it does, well, we'll assess it at the time. Remember, I gave you, there were divergences recently, and that's where you can sniff out these, 60-minute divergences will often be the catalyst for pullbacks, and that's what we had so far. It's just like that IWM chart I showed you in the beginning. Let's start here. Divergent high, correction. Divergent low right here, rally. Divergent high right here, correction. Divergent high, correction. Divergent low right there, rally. Divergent high, correction. Do we do that? It's possible. Can't underestimate these divergences, but I'm leaning towards this scenario and another thrust up to that big old 1838-ish resistance level, and then if and when that's broken, quite bullish in my opinion. Lean hogs, HE, just to do an update there. It's back to that support I pointed it out at the other day, 73. It had a little upside, fell back there. Any marginal new low, really technically at this point, it did put in a divergent low right there. Again, it's just not taken off. It needs to take out this trend line, and if it does, that would be another buy signal bullish, take us up to that 77 target. Again, I've kind of cooled off. I don't have a strong opinion on it now. I just wanted to say that. But if you took it here the other day, you're back to there. Have a stop somewhat below, and then I also mentioned you could pair it up with a short on LE, and that short trade already played out. So you would have profited on that. I'm trying to find LE. That's live cattle. I've got a ton of charts here. There it is. Got a little wonky candlestick. There. Okay, I got rid of it. And that was it. So I mentioned it here. It had a divergent high, negative divergence on this 60-minute chart, and boom, it fell right down to that 128.517 support / target level I had, and so that would have been a profitable trade there if you shorted the pullback and hedged up, and then remove that hedge there. You're probably, I don't know, back to where you started or a little bit profitable if you count the gains on this, if you did short that, compared to, washed out with the fact that live lean hogs are back to where they started. Okay, guys. All right, so let's, like I said, focus on the markets right now with the FAAMGs this week and the precious metals, and of course natural gas. I'm really liking to keep an eye on that potential head and shoulders pattern. This has been Randy Finney with Right Side of the Chart. Have a great day.